To understand where the dividend is going, we first have to master the engine of MSTE. This is a sophisticated macro instrument, not a simple savings account. It's built on a 25% leverage mandate, effectively putting you 1.25x long on MicroStrategy MSTR. To fund the high distributions, the fund sells covered calls on about 33% to 50% of its holdings. This creates a constant tug-of-war between two forces: the leverage, which craves explosive upside, and the covered calls, which harvest rent from market volatility. When the underlying asset drops, the leverage amplifies the pain, making the income generated by the options the only defensive line protecting the fund's net asset value, NAV. The historical dividend slide we've witnessed is a perfect mirror of the macro cooling in the Bitcoin ecosystem. In the early days, the euphoria around Bitcoin sent MSTR's price and volatility to the moon, allowing MSTE to pay out a staggering 60 to 66 cents. However, as the market entered a consolidation phase, the fund had to retreat. We saw the payouts drop to 55, 45, 35, and eventually 15 cents. This isn't management being cheap, it is the mathematical reality of a shrinking NAV. You cannot sustainably pay out a massive percentage of a shrinking pile of capital without causing a death spiral. The current 1.5 cent level is a defensive crouch, waiting for the macro tide to turn. The real secret sauce of this fund isn't the stock price, it's the implied volatility, 4. In a macro sense, volatility is the raw commodity that MSTE mines and sells to you as income. Currently, MSTR's volatility has compressed to around 71%. While that still leads the market compared to tech giants, it is a far cry from the triple-digit chaos of a year ago. As the crypto market matures and institutional liquidity deepens, these volatility premiums naturally shrink. For MSTE, this means the rent it can collect is lower. If both the asset price NAV and the rent IV are down simultaneously, the macro pressure to cut the distribution becomes almost irresistible. Let's talk numbers. At a 1.5 cent monthly payout and a price of roughly $3.48, MSTE is sporting a 52% annual yield. From a macro risk perspective, a 50% plus yield is a flashing red light. It signals that the market is already pricing in a cut. I believe there is a very strong probability that we see a reset to 12 cents or even 10 cents in the next cycle. A move to 12 cents would bring the yield to a still massive 41%, which is far more sustainable given the current volatility levels. While a cut feels like a loss, it actually prevents the fund from cannibalizing itself, ensuring that there is enough capital left to participate in the next Bitcoin rally. We can validate this by looking at the broader macro landscape, specifically the US-listed counterpart MSI. MSI runs an almost identical strategy, 125% leverage on MSTR with a similar option overlay, but its yield is currently hovering around 29%. This massive gap between MSTE's 52% and MSI's 29% is unsustainable. The Canadian market isn't a magical vacuum. It must eventually converge with the global reality of option pricing. A distribution cut isn't a sign of mismanagement. It's a necessary alignment with the global macro yield curve for this specific asset class. Expecting 50% when the market reality is 30% is how investors get trapped in yield chasing. It's important to clarify that the management team is navigating market weather, not management error. They don't control the price of Bitcoin. If they were to force a 1.5 cent payout in a low volatility, low NAV environment, they would be forced to sell more of the underlying shares to cover the check. This is the definition of destructive return of capital. By cutting the payout, management is actually protecting your long-term wealth. They are opting to keep more Bitcoin exposure inside the fund so that when the market eventually bounces, the fund has the firepower to recover. It's a trade-off, a smaller check today for a much higher share price tomorrow. The golden rule of macro investing is that total return is the only truth. Most retail investors are yield blinded. They celebrate the 15 cents hitting their account while ignoring the 0.2 drop in their principal. In a derivative fund like this, the dividend is simply a liquidation of your own equity. If your total account balance is shrinking, the high yield is an illusion. To judge MSTE fairly, we must look at the sum of price appreciation plus dividends. If the management is doing their job, the total return should track MSTR over the long term, outperforming in sideways markets and slightly lagging in vertical moonshot rallies. Let's look at the ex-dividend mechanics through a macro lens. Every time MSTE pays out that 15 cents, the stock price drops by exactly 15 cents. If they cut it to 12 cents, the stock only drops by 12 cents. Because MSTE uses 25% leverage, every cent of share price you save by paying a lower dividend is amplified on the way back up. If the share price erodes too far, the leverage starts to work against you, making it harder to recover from dips. By keeping the share price heavier through lower distributions, management is giving the fund a better launchpad for the next bull cycle. We now have over 13 months of data since the March 2025 inception. When you plot MSTE against the raw MSTR stock and its unleveraged sibling, MSTY, the correlation is nearly 1-to-1. This is excellent news. It proves that the tracking is working and there is no hidden decay in the management's execution. The fund is doing exactly what it was built to do. The reason investors feel down is simply because the underlying asset MSTR has been in a macro downtrend. The fund isn't broken, the market is just in a consolidation phase. When the macro cycle for Bitcoin turns bullish again, these charts will flip just as quickly. Interestingly, the data shows that in a sideways or bearish macro environment, the unleveraged version MSTY is the clear winner. Why? Because leverage is a cost. You are paying to borrow money to buy an asset that isn't growing. In a flat market, that interest drag eats into your returns. MSTY, being unleveraged, avoids this drag and survives purely on the rent from the covered calls. This is a vital lesson in macro positioning. You use the leverage tool, MSTE, when you have high conviction in a vertical move, but you stick to the income tool when you expect a choppy, range-bound market. However, the reflexive nature of MSTE is what makes it a powerhouse. During the rallies we saw earlier this year, MSTE didn't just track MSTR, it outperformed it. This is the double win scenario. The underlying stock price goes up and the 25% leverage multiplies that gain. Simultaneously, as the price surges, implied volatility usually spikes as traders scramble to buy calls, allowing MSTE to sell its options for even higher premiums. This convexity is the reason MSTE exists. It is a high-performance vehicle designed to capture the fat tail events of a Bitcoin bull run. You don't buy this for a steady income, you buy it for the explosive alpha. Let's analyze the crash resilience. Since common inception, MSTR is down about 60%. Mathematically, a 1.25x leverage fund should be down 75%. Yet, MSTE is only down 62.4%. This is a massive macro victory. It means the covered call strategy was so effective that it managed to cancel out almost the entire 25% leverage penalty during a brutal market crash. To be only 2% behind the raw stock while carrying significantly more risk is proof that the income strategy is working as a functional hedge. It turns a high-risk leveraged bet into something that behaves more like the raw stock but with a constant cash flow. Looking at 2026 specifically, MSTE has actually been outperforming the raw MSTR stock year to date. This happens because, in a volatile but slightly negative market, the cash yield provides a floor. While the raw stock just sits there and bleeds value, MSTE is constantly rebalancing itself by taking cash out of the option market and putting it into your pocket. This suggests that we might be reaching a macro bottom where the income component is finally strong enough to overcome the leverage drag. This recent outperformance is a strong signal that the strategy is anti-fragile during periods of high uncertainty. We have to trust the Harvest philosophy. They are an institutional grade manager in Canada, and they have a reputation for being the adults in the room. They aren't going to yield trap their investors by keeping a high dividend that destroys the NAV. If they cut the dividend to 12 cents, it's a sign of strength, not weakness. It means they are prioritizing the long-term survival of the fund over short-term marketing. In a macro sense, you want a manager who is willing to make the hard call to protect your capital. A dividend cut today is the insurance policy for the rally tomorrow. How should you position yourself? It all depends on your macro horizon. If you think the crypto cycle is dead, you should exit now. But if you believe Bitcoin is the future of global reserves, then a 3 cent or 5 cent change in the monthly distribution is just noise. The real play is the massive re-rating of MSTR that will happen when Bitcoin hits 6 figures. MSTE is your leverage ticket to that event. Don't let a temporary reduction in rent cause you to sell your property right before the neighborhood booms. The smart money uses these dividend scares to accumulate more shares while the weak hands are selling. We need to address the income trap psychology. Many retail investors use these funds to pay their bills, which is a macro mismatch. MSTE is a total return vehicle with a distribution wrapper. It is not a corporate bond. When the dividend gets cut, these investors are forced to sell, creating downward pressure. But for the savvy investor, a cut is actually a tax-efficient event, as it keeps more growth inside the share price rather than forcing a taxable distribution. If you don't need the cash today, you should view a dividend cut as the fund reinvesting in itself on your behalf. What does the macro turnaround look like? It starts with a Bitcoin breakout. As MSTR begins to climb, its volatility will naturally spike as the market bets on the move. This allows the fund to raise its rent payout almost immediately. Simultaneously, the 25% leverage starts to work in your favor, ballooning the NAV. This creates a virtuous cycle where the share price rises, the dividend rises, and the yield attracts new investors. We are currently at the bottom of that cycle, where sentiment is at its lowest. In macro investing, this is usually the point of maximum opportunity. Consider the worst case scenario. If Bitcoin continues to bleed, MSTE will continue to drop, and the dividend could go as low as 5 or 10 cents. But even then, you still own a leveraged piece of a company that is essentially a Bitcoin bank. The fundamental value of the Bitcoin held by MSTR doesn't change based on an ETF's distribution policy. As long as you believe in the underlying asset, the temporary adjustments in the income are just a part of the cost of carry for a high-performance leveraged position. In summary, the macro data is telling us that a distribution cut is likely, but it's also telling us that the management is doing a fantastic job. They have successfully hedged a 25% leverage position during a 60% market crash. That is an A+ performance in any book. By right-sizing the dividend to 12 cents, they will preserve the fund's capital and prepare it for the next leg up. If you are a long-term macro investor, this is exactly what you want to see: responsible management navigating a volatile landscape. Final thoughts. Ignore the panic and stick to the math. MSTE is a powerful tool, but it requires a total return mindset. If the dividend drops this month, don't see it as a loss. See it as the fund tightening its belt to survive and thrive. The macro fundamentals of Bitcoin and MSTR remain the real drivers here. If you found this breakdown helpful, please show some support. It keeps this high-level analysis coming. Let me know in the comments, are you holding for the long haul, or is the volatility starting to bite? Stay safe, stay passive, and stay honorable. I'll see you in the next analysis.